Welcome back. The Q3 earnings season is officially kick-started today. Today, TCS is expected to report numbers. In the mid-cap pack, you've got Tata Elxsi. And next week, then a whole host of companies like Infosys, Wipro, HCL Tech all report. So let's quickly get you up to speed in terms of the expectations. Ankur Rudra, head of APAC Telecom and lead analyst for India TMT at JPMorgan, is now with us on the show. Ankur, thank you very much for joining in. First, give us the broad expectations going into the earnings season.
Hi, thank you for having me. So look, this earnings season, we are looking at a quarter which has been impacted by furloughs. We're also looking at a quarter where there's been very sharp currency movements in the last month. So our expectations are not extremely high, especially for the large caps. On the large caps, we expect a relatively muted quarter where, a lot of companies will be sort of at flat growth. And so basically flat to 2% organic is what we are expecting. And the main focus area, at least for the large caps, will be how much of the positive commentary in the past we've seen that was limited to financial services and some early signs of discretionary spending, how widely that spreads out. Does that increase to sectors such as retail, where December is an important sector, important quarter? Or does that extend to some of the other areas such as manufacturing, where we've had mixed commentary so far? We are a bit more optimistic on the mid-cap front, where the growth momentum can be meaningfully higher. The range is more broader from the 2 to 5-ish% range, where the growth is relatively better. Going forward, again, I think the main thing to watch out there again is how much beyond the US, how much beyond financial services do we see growth coming in? And how does that set us up for the calendar 25, fiscal 26, outlook going forward?
So talking about the setup going into this calendar year, well, IT stocks have had a fantastic run-up. It's been a 20% plus return for the Nifty IT index now for 2 consecutive years. So some say that perhaps the good news, the recovery is priced in. Where do you stand on that, given the run-up and the starting point, valuations being richer, and how are investors approaching Indian IT now? Are they largely overweight?
Yeah, so I think if you look at the IT sector, it's had another good. The stocks have had another good year. The Nifty IT or the NSE IT has outperformed the Nifty by 20% for the year, 8% for the last quarter, and maybe 2 or 3% for the last month. So it's been a consistent outperformer. It's not just one period, one month or one quarter it outperformed. Now, having said that, we haven't seen adequate evidence of underlying bottom-up large cap or industry performance improving meaningfully. We currently do not, for example, see a significant growth acceleration for the large caps, at least, or for the industry at large in CY25, F26. So while there was a small amount of growth acceleration, maybe by 150 basis points last year, the industry went to perhaps 3 to 5% growth. The next year probably promises around 4 to 6, 4 to 7 at best. So we are not looking at a very, very sharp growth acceleration here. Now, investor positioning has turned a bit more, I would say, optimistic in the last 6 months or so. Investors have bought into the names, not only for the fact that they're expecting bottom-up performance, but also there is an element of macro where investors do want to diversify to exporters. Investors want to play the US dollar, the US economy to a large extent. Now, I think that's where we see positioning. We are not getting that much of evidence yet that we are looking at a year of double-digit growth or even very high single-digit growth for fiscal 26 or calendar 25 just yet.
Ankur, so you just mentioned going into this particular quarter, almost 6 months, there's been some optimistic positioning as far as the IT space is concerned. Now, in terms of commentary, what is it, will you feel, if companies come out, number one, will be taken positively, and what, according to you, what that management could say, could be construed negatively by the street going into this particular earnings season?
Yeah, sure. So, we are expecting some companies which are guided relatively conservatively to upgrade the guidance. And any kind of, better than expected guidance upgrade will be seen positively. We are also expecting commentary around discretionary spending. If the discretionary spending commentary, which was largely centered around the financial services industry, if that spreads to many more industries, if there's evidence that deal wins which have begun to flatline for the large deals especially, have been begun to flatline for the last few quarters. If that begins to perk up, we're not expecting that just yet, but if the commentary around it is positive, if the momentum around signings or pipeline creation is positive, I think that will be seen a bit more optimistically and positively. In terms of potential headwinds and negatives, I think the main thing to watch out for is any commentary around the furloughs. If there is commentary that the furloughs that were seen so far only in the December quarter are likely to extend to the March quarter also, that could be a negative. If we hear commentary about, the discretionary spending not really extending beyond financial services or sort of slowing down, if there's any evidence of the growth momentum going sideways as opposed to up, even if it is slow, I think that will be seen negative. And lastly, there will be a view on margins as well. If there's any kind of margin headwinds highlighted, that I think something people will be watching out for. Finally, headcount addition has been moving. It was negative for most of the first half of calendar 25. It's turned flat to positive for the last few quarters. If that's another thing to watch out for, to see, because that does indicate to an extent management willingness to bet on growth for the future periods.
Are you seeing margin headwinds for the IT companies going into next year?
I think the headwinds are, one, if there's any kind of lack of momentum beyond financial services, because given, like you said, these stocks are trading at relatively healthy multiples, there is an expectation that growth will be mid to high single digits. If there is an evidence just immediately that that's unlikely to happen, I think that could be a challenge. If there's any kind of margin related headwind flagged, in terms of maybe, for example, on the visa side, that's been a point of debate very recently. That could be a headwind. If there's any kind of conversation about AI eating into the opportunities, if that's seen as a negative, that could that could also be seen as a negative. And finally, if there's any kind of pricing pressure, I think that's another thing to watch out for.
Ankur, headed into Q3, where are you more optimistic on? Is it the large cap IT companies? Is it the mid cap IT companies? And if you could also bifurcate them in terms of companies with exposure to BFSI or any other vertical, where will you be more optimistic on?
Sure. So overall, that's easy to answer. We prefer mid caps over large caps right now. We think we are seeing some signs of discretionary spending coming through. We are seeing some smaller deals coming through, and those companies are able to capture that. They're not impacted by the macro as much. We like, in general, mid caps, but within that, we do like, companies which have been able to maintain strong, mid-teen kind of growth rate, which we call growth heroes. We like them. We like financial services recovery plays. We like companies which can potentially benefit from any kind of AI-related spending, which have a strong amount of data and analytics exposure. And a part of the ER&D companies which can see some sort of a growth acceleration this year. So those are the sort of subsectors we prefer within the broader IT and ER&D services space.
And just one final quick word. When you spoke to the management in the quarter, November, December, what did they tell you about discretionary spending extending beyond the financial sector? Is there evidence of that?
Sure. So yeah, we speak to a lot of management teams. Last quarter, we spoke to several industry experts too. I think the broad answer so far is that it's most visible within financial services, while discretionary spending is a topic which is sort of a debatable topic. Many companies define discretionary spending different ways. Some companies include small size deals, but what was consistent is that small size deals have begun to come back. Now, whether you call it discretionary or not could be a matter of opinion, but that is something we did hear is spreading beyond financial services, may not be discretionary spending per se. So I think we've heard specific to discretionary on financial services, but again, the optimism was largely around financial services just yet. And this is again Q3 oriented. So we'll want to watch out for how that extends for the quarter beyond that.
Thank you so much, Ankur, for joining us and giving us a sense of how exactly investors can look at for the entire IT earnings that will kickstart today with the TCS numbers.